Well, in this video, we're going to talk about the differences between fiscal and monetary policy. Now, these are both different tools that the government can use to try and stimulate the economy. And the differences, of course, are how that is done, or the manner in which the government attempts to stimulate the economy, but also the role that government plays, because depending upon which policy is chosen, there's a different person making the decisions. And so for the sake of this video, we're going to focus on how these two policies work here in the U.S. in broad terms. And then, of course, you can do a little bit of research to get a little bit more information if you want to dive a little bit deeper. So let's first talk about fiscal policy. Now, fiscal policy is the government's attempt to influence the economy utilizing two specific measures. So we're going to utilize one, taxation, and two, we're going to use government spending. And so with fiscal policy, the government is going to use these two tools. So either taxation, so what you and I pay or don't pay in form of taxes, so we can increase or reduce that. We can offer tax rebates and different things, but also government spending. And so the government is responsible for quite a bit of spending, and it ranges anywhere from 10 to 15% of GDP. And the government can use this as a way to prop up certain industries or try to reinvigorate the economy as a whole. Now, fiscal policy kind of follows the basic idea of the Keynesian economic theory, which is basically that the government can increase spending to stimulate the economy when it deems it necessary. So the logic here is, if we were to take first off, government spending, the government is going to inject some kind of money into circulation. Now, the important distinction in fiscal policy is we are not creating new money. This is merely a redistribution of money. So the government obviously takes money in the form of taxes, and then, of course, doles that money out to various government agencies and entitlement programs and different things like that. So the government can essentially choose to reduce taxes in a certain area, like we did in 2009 with the payroll tax holiday, reducing Social Security taxes from 6.2 to 4.2%, which essentially gives people more money. Now, that, of course, costs something because the government is losing out on that revenue. So let's say we were to do something of that nature. So that government spending is then going to go into the pockets of consumers. And so consumers now have access to more money. And so consumers, what we know is we are typically very poor savers. And on average, it ranges about 2 to 3%. I think currently, at least at the recording of this video, it is about 5% as people attempt to kind of just shore up balance sheets still in recovery from the Great Recession of 08 and 09. So when we get access to this kind of increased monies, we're likely going to spend it. So that spending is going to re-inject the money into the economy and is going to create demand for businesses. So in turn, what's going to happen with that increased demand is businesses are going to sell through inventory and offer services. And then they're, of course, going to have a need to hire, which is going to affect the unemployment rate. And then when unemployment rate is lower, people have access to more money. And so that, of course, is going to impact consumer spending. So with people having, or being employed rather, that is going to impact their discretionary income, which is going to allow them to spend more. So the basic logic here is that by providing some kind of stimulus, you're going to give consumers the ability to have access to money, which in turn they are going to spend, which is going to create demand or business demand for different goods and services, which is, of course, going to hopefully put them in a position to need capacity or need supply, so they're going to hire, and more people with more jobs is going to mean more discretionary income, which means increases in consumer spending. So that's the general logic behind how fiscal policy works. Now, fiscal policy is, of course, controlled by the legislative and executive branches, and of course, they work together to try and do some kind of policy within their parameters. Now, that contrasts with monetary policy. So monetary policy is a little bit different. Monetary policy is actually controlled by this government entity known as the Federal Reserve. And you've probably heard of the Fed before. And the Fed is responsible for a number of different things, but it has a primary role in monetary policy. So let's talk a little bit about the Federal Reserve. So the Federal Reserve is kind of this quasi-government agency. It's independent of the federal government, but it does take some, I wouldn't say direction from it, but the chairman or chairwoman of the Federal Reserve is appointed by the president. So there is a little bit of oversight in that regard. The Fed, of course, reports to various congressional subcommittees and committees. So there is some oversight. But in large part, the Federal Reserve is managed by this Board of Governors and the FOMC, which is the Federal Open Markets Committee that make decisions on what to do in terms of monetary policy. So let's talk about what really is monetary policy and how does it differ from fiscal policy. So monetary policy involves influencing the economy through two tools. So we're talking specifically about what we call the money supply, or the supply of money in circulation. So this is the available currency that's out there for us to spend. And then, of course, interest rates. And interest rates affect a number of different things, like rates for borrowing. And the Federal Reserve can manipulate these, and that sounds like a negative term, but really alter them in a way to kind of either help increase the likelihood of consumers having access to money and spending, or if the economy is growing too quickly, they can choose to kind of reel it in a little bit. And so if they're worried about inflation, there are things that they can do. So the basic, without going into too much detail, really the idea behind the money supply is the Fed can either increase the supply of money, which gives people access to more money, or it can decrease the supply of money, which of course is going to reduce the availability of money for spending. And depending upon the situation in the economy, if the economy is not growing at a very brisk pace, if it's rather anemic, sort of the growth that we're in currently, the Federal Reserve can increase the supply of money, either through purchasing treasury bonds or different types of securities, mortgage-backed securities. And what that does is that increases the available fund of money. And so if you were to think about the supply of money, as kind of this pie sort of thing, and you were to say that this represents $5 trillion, the Federal Reserve can engage in some kind of accommodative monetary policy in the form of purchasing bonds, and it can actually increase that supply of money. And so by doing so, that allows consumers access to more money that we can take in the form of loans, because primarily the Fed increases the supply of money through banks, and then we can get access to whether it's vehicles or homes. Businesses can purchase equipment and expand and those types of things. Now with interest rates, it works kind of in a similar fashion. So interest rates are of course tied to loans, and so the Fed can increase rates when it wants when it's worried about the economy that's growing too quickly. And so by increasing rates, essentially people really don't want to borrow. And so you're going to see borrowing kind of peak and begin to decline, because if you're getting an 8% interest rate on a loan, it's not really advantageous. Banks want to take loans for relatively inexpensive from the Fed, and then of course lend the money out for more money to you and I. And if the rates are higher, there's not really an incentive for banks to borrow and lend. However, if the economy is not doing well, the Fed can decrease these rates. And essentially, it's really easy money for the banks. And so they're going to take this money and they're going to increase borrowing. And then from we know with consumers and kind of our spending, consumers can then take that money and then they are going to spend it on different things. And so if we get a loan for a house or a vehicle or any number of things, that's going to get back into the circulation, into the economy, and then ideally it's going to help increase growth. And so really the focus here, at least for the takeaway, would be fiscal policy, primarily controlled by executive and legislative branches, involves influencing the economy through taxation and government spending, while monetary policy is controlled by the Federal Reserve, and that is trying to influence the economy through the supply of money, or the available supply of money, as well as through interest rates.